So what if I told you that the global derivatives market is estimated to be worth over $1 quadrillion?
Yeah, which is just, it's almost an unfathomable number.
Right. I mean, that is a 1 followed by 15 zeros. It's a number so staggeringly large that it actually, it exceeds the value of all the tangible wealth on planet Earth.
It really does.
All the real estate, all the physical gold, the manufactured goods, every single company. The paper contracts derived from those things are somehow traded at a volume that completely dwarfs the physical reality of the world itself.
It's a phenomenal statistic.
Yeah.
And, well, it perfectly highlights the scale of what we're actually dealing with here. We're talking about the invisible scaffolding that kind of dictates the movement of global capital.
Exactly. And today, our mission is to make that invisible scaffolding visible for you. We're going to find out how a piece of paper, or I guess more accurately today, a digital entry, right?
Yeah, all digital now.
Yeah, how a digital entry derived from a barrel of oil or a basket of stocks can become the most powerful financial instrument ever created. So, we're bringing you a deep dive based entirely on Chapter 5 of the National Institute of Securities Markets, or NISM, Series XXIA Portfolio Management Services Distributors Certification Workbook. That's a mouthful, but that is our grounding material for today.
It is a dense workbook, but it's fantastic.
It really is. We are going to demystify derivatives because, usually when people hear derivatives, they picture complex math, Wall Street chaos, or just extreme unmanageable risk.
Yeah, it gets a bad rap.
It totally does. But the goal here is to strip all that away. We want to break down the fascinating logic behind why these tools were invented in the first place, how they function mechanically, and specifically how professional portfolio managers utilize them.
And, that foundational logic is what usually gets lost when people discuss this topic. Because these instruments weren't just created in a vacuum for, the sole purpose of casino gambling. They emerged organically over centuries to solve very specific, very tangible economic problems related to risk. So if we can understand the problem, the derivative itself suddenly makes perfect sense.
Okay, so let's start at absolute square one. Before we can trade them or regulate them, we have to define what they actually are. The term itself, derivative, it implies that something is being pulled from another source, right? Like a dependent variable.
Yeah, the word itself really is the definition. A derivative is simply a contract. But unlike a standard contract where you might, buy a car or a house.
Where the thing itself has value.
Exactly. This specific type of contract has absolutely no intrinsic independent value. Its entire financial worth is derived from the price movement of something else. And we call that something else the underlying asset.
Okay.
So the underlying asset moves, and the derivative contract moves in tandem based on the specific rules that are written into that agreement.
And looking at the NISM text, it provides a massive list of what these underlying assets can actually be. I mean, it's not just limited to corporate stocks.
Not at all.
You've got the metals market, so gold, silver, copper, zinc, nickel. You have energy resources, which are basically the lifeblood of the global economy, right? Crude oil, coal, electricity, natural gas.
Yeah, the big ones.
And then agricultural commodities like wheat, sugar, coffee, cotton. And obviously, the purely financial assets, equity shares, corporate and government bonds, foreign exchange currency rates. It covers everything.
It really does. And the breadth of that list, it just shows how deeply integrated these contracts are into really every sector of the economy.
Yeah.
And, well, because they're so integrated, the legal framework governing them has to be incredibly robust.
Right. The regulation has to keep up.
Exactly. So the source material points us to the Securities Contracts Regulation Act of 1956, commonly referred to as the SCRA.
Okay.
Under this act, the legal definition of a derivative is, well, it's quite broad. It defines it as a security derived from a debt instrument, a share, a loan, whether that's secured or unsecured, or a risk instrument. It also explicitly includes something called a contract for differences.
I was looking at the Reserve Bank of India's definition as well, the RBI, and they cast an even wider net. They define a derivative as an instrument that is to be settled at a future date, deriving its value from changes in interest rates, foreign exchange rates, credit ratings, or the prices of securities.
Yes.
So the RBI is making sure that these complex, sort of invisible interdependencies, like a change in a company's credit rating or a shift in the national interest rate, are officially recognized and regulated as derivatives under the law.
And that inclusion of things like credit ratings and interest rates is vital.
Yeah.
Because it moves us away from, physical objects like wheat or oil and into the realm of pure financial risk.
Right.
The RBI definition explicitly names interest rate swaps, forward rate agreements, foreign currency options. They're basically ensuring that the legal infrastructure covers every possible iteration of risk transfer you could think of.
Okay, I want to try an analogy here to see if we can make this idea of an underlying asset and derived value totally concrete for you, the listener.
Let's hear it.
Think of a derivative like holding a betting slip at a horse race. The betting slip itself is just a tiny piece of cheap paper, right? It has zero intrinsic value. You can't eat it, you can't build a house with it.
Right.
But its financial value depends entirely on how fast a specific horse runs on the track. The horse is the underlying asset.
That's a great way to look at
You
it.
don't own the horse. You aren't responsible for feeding the horse or housing it in a stable or paying the jockey. But you have a very real, very measurable financial stake in the performance of that horse.
Exactly. The mechanics of the betting slip perfectly mirror the mechanics of a derivative contract. If the horse places last, the piece of paper in your hand is mathematically worthless. But if the horse wins, that exact same piece of paper can suddenly be exchanged for a massive amount of capital.
Right.
The paper merely tracks the performance of the asset.
But this naturally leads to a pretty massive question. If I've done my research and I firmly believe a specific company is going to double its revenue, or I don't know, if I believe the price of gold is about to skyrocket, my first instinct is to simply buy the company's stock or buy physical gold bars.
Of course.
Why not just buy the horse? Why create this entire secondary, highly complex layer of contracts and betting slips? Why extract the value from the asset instead of just holding the asset?
That is the core question. And the simplest answer is that owning the underlying asset is frequently impractical, highly expensive, and sometimes entirely undesirable.
Okay, how so?
Well, let's take physical crude oil as an example.
Yeah.
Imagine a major commercial airline.
Okay.
They know, mathematically, that they will need to consume millions of gallons of jet fuel over the next 2 quarters just to keep their planes in the sky. And they're looking at the geopolitical landscape, and they are terrified that conflicts might cause the price of crude oil to double.
Which makes total sense, because if the price of crude oil doubles, their fuel costs double, and their carefully planned profit margins are instantly obliterated. They'd be operating at a massive loss.
Exactly. So the airline needs exposure to today's crude oil prices to lock in their costs and protect their business model.
Yeah.
If they wanted to do this without derivatives, they would have to go into the physical market and purchase tens of thousands of actual physical barrels of crude oil today at today's price.
Which introduces a whole new set of catastrophic logistical problems. I mean, where does an airline store tens of thousands of barrels of unrefined crude oil?
They don't.
Right, they'd have to purchase massive storage facilities, they'd have to pay for industrial transport.
Furthermore, they would have to pay exorbitant insurance premiums for storing hazardous, highly flammable materials. They'd have to deal with environmental regulations, security, and the eventual cost of actually refining that crude into usable jet fuel.
It's a nightmare.
It is. The logistical friction of physical ownership completely defeats the financial goal. The airline does not want to be in the oil storage business. They just want to eliminate the risk of the price changing tomorrow.
Ah, okay, so the derivative acts as, like, a surgical tool?
Yes.
It allows the airline to completely extract and isolate the price risk of the crude oil from the physical reality of the crude oil. They can manage the financial volatility on a spreadsheet without ever having to take delivery of a single drop of oil until the exact moment they need it for their planes.
That's beautifully put. It is the ultimate mechanism for risk transfer. Once you understand that derivatives separate price risk from physical ownership, the entire market begins to make sense.
Okay, so now that we've established what a derivative is and the fundamental problem it solves, we need to trace how these instruments actually evolved. We have to look at the oldest, most rudimentary way humans started trading these future obligations.
Right, taking a step back in history.
Exactly. Which takes us to the concept of forwards. And looking at forwards requires us to confront the inherent fragility of human trust.
Yeah, the historical evolution of these contracts is essentially a centuries-long battle against systemic risk.
Yeah.
A forward contract is the absolute bedrock, the most basic form of a derivative.
Okay.
It's an over-the-counter, or OTC, agreement negotiated directly between two parties. They sit down, face-to-face, and agree to buy or sell an underlying asset on a very specific future date at a price they mutually lock in today.
So it's a private handshake deal.
Basically, yes.
Two business owners agreeing on terms without any middlemen. Like, for instance, a local baker agrees to buy a ton of wheat from a local farmer 3 months from now, and they agree the price will be, say, 50 rupees per kilogram.
Perfect example. And the defining characteristic of the forward contract is that it is completely bespoke. It's tailor-made to the exact specifications of those two individuals.
Right.
Because there's no central authority dictating the rules, the baker and the farmer can negotiate every single detail. They decide the precise quantity down to the gram, the exact acceptable quality or grade of the wheat, the specific delivery date, even the specific warehouse where the delivery has to happen.
And in a perfect world, that sounds ideal. You get a contract customized perfectly to your supply chain needs. But the Anti-FM workbook highlights two massive structural limitations that plague forward contracts: liquidity risk and counterparty risk.
Yeah, and those two risks are the anchor that held historical financial markets back from true global scale. Let's dissect liquidity risk first.
Okay.
The very thing that makes the forward contract appealing, its highly customized, bespoke nature, is exactly what makes it a massive liability.
How so?
Well, imagine our baker, 2 months into this 3-month contract, suddenly suffers a family emergency and decides to close his bakery and move to another city.
Oh, wow.
Okay. Yeah, but he is currently holding a legally binding contract obligating him to purchase a massive amount of wheat next month. He needs to sell that obligation to someone else.
Right, so he goes to another baker in town and tries to sell the contract, but the second baker looks at it and says, I don't need the delivery on the 14th of the month, I need it on the 28th. And I don't want it delivered to the north side of town, my warehouse is on the south side. Plus, this specific grade of wheat doesn't really work for my bread.
Exactly.
The second baker refuses to buy the contract because the custom measurements just don't fit his business.
That is liquidity risk in action. Because the contract is highly specialized, the secondary market for it is practically non-existent.
Yeah.
The original baker is trapped. He can't easily exit the position or convert that contract back into cash. He is stuck with an illiquid asset.
Man, okay. But then there's the second limitation, counterparty risk, which seems significantly more dangerous. Because it's not just about being stuck with a contract, it's about the other person completely reneging on the deal.
Counterparty risk is the ultimate nightmare in an over-the-counter market. It is the very real danger that the person on the other side of the handshake simply defaults on their obligation when the time comes.
Let's play out the default scenario with our baker and farmer.
Sure.
So they locked in the price of wheat at 50 rupees. But 2.5 months later, a massive drought hits the region. The global supply of wheat plummets and the open market price of wheat skyrockets to 150 rupees.
Yep.
The farmer realizes that if he honors his forward contract with the baker, he will be selling his precious wheat for a third of what it is currently worth.
And human nature takes over. The farmer calculates that the financial penalty of breaking the private contract might actually be less than the massive profit he could make by selling the wheat on the open market at the new hyperinflated price.
Right.
So delivery day arrives and the farmer simply doesn't show up.
And because it's a private OTC contract, the baker has very few immediate options. I mean, there's no central authority to enforce the trade instantly. The baker's only recourse is to hire lawyers, take the farmer to civil court, and endure a legal battle that could take years.
I could have said.
And more importantly, a lawsuit does not provide the flour he needs to bake bread for his customers tomorrow. His business is effectively ruined because the chain of trust broke.
That's it. And the broader market eventually realized that an economy cannot scale if it relies entirely on the interpersonal integrity of individual counterparties. The risk of systemic contagion where one default triggers another, bankrupting a whole chain of businesses, it was just too high.
They needed a fix.
The market desperately needed a structural solution.
And that structural solution was the invention of the futures contract.
Yes. Futures contracts are the market's evolutionary leap forward. They take the core concept of locking in a future price, but they strip away the bespoke, risky nature of the forward market. Futures are highly standardized contracts that are traded publicly on an organized exchange rather than privately over the counter.
You know, the analogy that comes to mind is the difference between clothing.
Okay.
A forward contract is like hiring a master tailor to create a bespoke suit. It takes measurements of every inch of your body. It fits you flawlessly. But because it is cut exactly to your unique asymmetrical shoulders and arm length, you can almost never sell it to anyone else. It only holds value for you.
Right.
A futures contract, on the other hand, is an off-the-rack suit from a massive department store. It comes in standard, rigid sizes, small, medium, large. It might not fit your exact delivery date with absolute perfection, but because millions of people wear a standard size medium, there is a massive, highly liquid global market of buyers and sellers trading those exact same suits every single second of the day.
That's a brilliant analogy. The standardization is what creates the liquidity. When you trade on a futures exchange, you don't get to negotiate the terms. The exchange acts as the ultimate dictator of the contract's specifications.
Okay.
The exchange declares this specific crude oil contract represents exactly 1,000 barrels.
Okay.
The oil must be of this exact chemical grade and sulfur content, and the contract will expire precisely on the third Friday of the month. The only variable left for the buyers and sellers to negotiate is the price. Everything else is rigidly fixed.
So standardization solves the liquidity problem because everyone is trading the exact same identical instrument. But wait, how does standardizing the contract solve the counterparty risk? What stops the farmer from running away from a standardized futures contract when the price moves violently against him?
This is where we encounter one of the most brilliant mechanical innovations in financial history: the clearinghouse.
Okay, the clearinghouse.
When you buy a futures contract on an exchange, you might think you are buying it from a specific farmer or a specific speculator, but the reality of the legal structure is entirely different. The clearinghouse steps directly into the middle of the transaction. Through a legal mechanism known as novation.
Novation?
Right, novation. The original contract between the buyer and the seller is effectively torn up, and two new contracts are created.
So the novation process essentially severs the direct link between the two parties?
Entirely. The clearinghouse legally becomes the buyer to every single seller in the market and simultaneously becomes the seller to every single buyer in the market.
Okay, wait. So if I am sitting at my computer and I buy 10 lots of a nifty futures contract, I don't know the name of the person who sold it to me. I don't know their credit score. I don't know where they live. And I have no idea if they actually have the money to back up the trade.
And the beauty of the system is that you don't need to know, nor should you care. Your legal contract is not with that anonymous person. Your contract is exclusively with the clearinghouse. And the clearinghouse is a massive, highly capitalized institution that absolutely guarantees the financial settlement of the trade. They guarantee that the winner will be paid and the loser will be charged, regardless of whether the original person on the other side defaults or disappears.
That is wild. We've basically taken a market that relied entirely on the fragile, unpredictable nature of individual interpersonal trust, and we've replaced it with cold, hard systemic guarantees. We shifted from trusting a human being to trusting the vast capital reserves and strict mathematical algorithms of an institution.
Yes.
The institution absorbs the risk of default, so the market participants don't have to.
That shift from interpersonal trust to institutional trust is what allowed the derivatives market to explode into the quadrillions of dollars. It created a safe sandbox for global capital. Furthermore, this institutional backing allows for what the NISM text calls the figurative nature of buying and selling.
The figurative nature, let's break that down. Because when I buy a futures contract today, I'm not actually handing over the full cash value of the asset, and nobody is backing a truck up to my house to deliver the asset.
Correct. On day one, when the trade is executed, no underlying asset changes hands, and the full purchase price is not paid. You're simply entering into a mutual, legally binding commitment to perform an action in the future. The exchange provides the centralized platform to match the buyers and sellers, the standardized rules to ensure everyone speaks the same financial language, and the clearinghouse acts as the ultimate safety net to ensure everyone honors their future commitments.
Right. So we've established that futures contracts obligate both parties to act. It's a symmetrical obligation. If I buy the futures contract, I am legally forced to buy the asset at the expiration date. If I sell the contract, I am legally forced to deliver it. We're both locked into the destiny of the contract.
Right.
But what if a market participant wants the choice to act without being chained to the mandatory obligation? What if they want like a one-way street? That brings us to the wonderfully asymmetric world of options.
Options introduce a completely different psychological and mechanical dynamic. They fundamentally break the symmetry of obligation that defines the futures market. By definition, an option is a contract that gives the buyer the right, but absolutely not the obligation to buy or sell the underlying asset on or before a stated date at a stated pre-agreed price.
The key word there is right. It is a choice. And the text breaks this down into two primary instruments, call options and put options.
Right. A call option is the right to buy. It gives the purchaser the right to call the asset toward them, buying it at the specific strike price. A put option is the right to sell. It gives the purchaser the right to put the asset away from them, selling it at the strike price, regardless of how far the open market price has fallen.
Let's trace a call option through its life cycle so you can really picture this. Suppose I'm looking at a company whose stock is currently trading at 100 rupees. I think they're going to announce a massive new product, and the stock is going to soar. I buy a call option with a strike price of 100 rupees, expiring in 1 month.
Okay.
Fast forward a month. My prediction is correct. The new product is a hit, and the stock price explodes to 150 rupees on the open market. I hold a contract that gives me the absolute right to buy that stock at the old price of 100 rupees. I exercise my right, buy a stock at 100, immediately sell it on the open market for 150, and pocket a massive profit.
That is the ideal scenario for the option buyer. But consider the alternative. What if the product announcement is a failure and the stock crashes down to 50 rupees?
Right, what then?
If you were holding a futures contract, you would be legally forced to buy that stock at 100 rupees, taking a devastating 50 rupee loss per share. But because you hold an option, you simply look at the crushed stock price and say, I choose not to exercise my right. You walk away, the contract expires worthless, and you are not forced to buy the depreciated asset.
The buyer holds all the leverage when it comes to execution, but financial markets are incredibly efficient, and nobody is going to hand over that kind of massive one-sided advantage out of the goodness of their heart. There has to be a cost to having the power of choice.
Absolutely. The privilege of walking away comes with a strict financial cost. This brings us to the counterparty in the options market. The option writer, also known as the option seller.
Or render.
The fundamental rule of the options market is that while the buyer has no obligation, the writer of the option is strictly legally bound to honor the contract if the buyer decides to exercise it.
So if I exercise my right to buy that stock at 100 rupees, the writer is forced to sell it to me at 100 rupees. Even if the stock is currently trading at 150 or 200 or 500 rupees, the writer has to absorb that massive loss and deliver the shares to me at the agreed-upon lower price.
Yes, the writer takes on the entire burden of the obligation. To compensate for taking on this potentially devastating risk, the writer charges the buyer an upfront, non-refundable fee called a premium. The buyer must pay this premium out of pocket on day one just to acquire the contract.
I am looking at the risk profile of the option writer here, and I have to formulate a hypothesis. Because if I am the option writer, I am signing a legal document that forces me to perform if the market moves violently against me. The downside risk could theoretically be unlimited. A stock's price can technically rise to infinity, and I'd be forced to pay the difference. Meanwhile, the buyer can just walk away whistling if they gets wrong. The absolute maximum profit I can ever make as the writer is keeping that small upfront premium. Why would any rational actor take on theoretically unlimited risk for a small, capped reward? It seems structurally unbalanced against the writer.
It looks unbalanced until you view it through the lens of probability and the insurance business model. The options market is governed by the mathematics of risk-reward asymmetry. You're absolutely correct about the risk profiles. The option buyer has strictly limited risk. The absolute maximum amount of money they can lose is the premium they paid on day one. But they have theoretically unlimited upside if the asset surges. Is that a low probability, high reward bet? The option writer has strictly capped upside. They can never earn more than the premium collected.
Yeah.
But they have potentially massive downside risk.
So what justifies the writer's position?
The writer's position is justified by the law of large numbers. To understand the option writer, you have to look at how a massive insurance conglomerate operates. When you buy a comprehensive auto insurance policy, you pay the insurance company a premium every 6 months.
Right.
Your risk is strictly limited to the cost of that premium. But if you accidentally drive your car off a bridge the next day, the insurance company is legally obligated to buy you a brand new, expensive vehicle. The insurance company collects a small fee, but takes on the massive risk of replacing the underlying asset.
And why does the insurance company agree to that? Because they employ armies of actuaries who calculate the exact statistical probability of car crashes? They know that out of 1 million drivers, only a tiny fraction will ever total their cars.
Precisely. They know that the vast majority of those million insurance policies will expire unused at the end of the year. The drivers will stay safe, and the insurance company will keep millions of individual premiums as pure profit, which easily covers the cost of replacing the few cars that actually do crash. Option writers act as the insurance companies of the financial markets.
Oh, wow. So they're not making a directional bet on a single stock. They are betting on the mathematical probability across thousands of trades. They write thousands of options, collecting thousands of premiums, heavily betting that the vast majority of those options will expire out of the money.
Exactly.
The buyers will walk away, the contracts will vanish, and the writers will keep the premiums.
The option writers provide the essential service of risk absorption, and the premium is their mathematically calculated compensation for providing that service.
Okay, so we've covered futures and options, but the NISM material introduces a third major instrument in our toolkit, one that operates primarily in the massive institutional space: swaps.
Swaps are the hidden behemoths of the derivatives world. The general public rarely interacts with them, but they are critical for corporate finance. A swap is fundamentally an agreement between two parties to exchange or swap a series of cash flows over a specific period of time in the future.
To bring this out of the abstract, let's look at an interest rate swap. Imagine a massive manufacturing company. They just spent ₹1 billion building a new factory, and they financed it with a bank loan that carries a floating interest rate.
Okay. Floating rate.
This means their monthly loan payment is not fixed. It fluctuates up and down based on the broader macroeconomic interest rates set by the central bank.
And having a floating rate introduces severe unpredictability into their business model. If inflation spikes and the central bank aggressively raises interest rates to combat it, the manufacturing company's monthly loan payments will skyrocket.
Right.
This makes it nearly impossible for their chief financial officer to accurately forecast their quarterly profits or plan for future expansion. They are completely exposed to the unpredictable financial weather of the interest rate market.
So the manufacturer looks at their balance sheet and realizes they need predictability. They need a fixed interest rate so they know exactly what their expenses will be every single month for the next 10 years. But their current bank refuses to rewrite the underlying ₹1 billion loan.
Yep. Banks don't always play nice.
Right. So if I am that CFO, my hypothesis is that somewhere in the global market, there must be another institution sitting in the exact opposite position. An institution that currently has a fixed rate loan but actually wants the volatility of a floating rate. Am I using a swap to find that counterparty?
That is exactly how the mechanism functions. Imagine a second company, perhaps an aggressive hedge fund or a cash-rich tech firm, that currently has a loan with a fixed interest rate. However, their macroeconomic analysts firmly believe that global interest rates are about to plummet over the next 5 years.
Okay.
They want to take advantage of those falling rates to lower their borrowing costs, which means they actually want a floating rate.
So we have two entities with opposing needs. Company A has a floating rate but wants a fixed rate for stability. Company B has a fixed rate but wants a floating rate for potential profit.
Instead of going through the massive legal hurdle of refinancing their respective underlying loans with their banks, Company A and Company B enter into an interest rate swap contract with each other. Company A agrees to pay Company B's fixed interest payments. In exchange, Company B agrees to pay Company A's floating interest payments.
Wait, so they're essentially trading their debt obligations?
Yes.
The underlying ₹1 billion bank loans never change hands, and the principal amounts are never exchanged. They are exclusively swapping the stream of cash flows generated by the interest.
Through the derivative contract, Company A has artificially transformed its floating rate debt into fixed rate debt, achieving the budget stability they desperately needed. Company B has transformed its fixed rate debt into floating rate debt, gaining the exposure they wanted.
That is incredible.
The swap allows institutions to radically alter their risk profile and fundamentally restructure their balance sheets without ever touching the primary underlying assets.
They are basically trading financial weather. It's a brilliant concept. Okay, so we now have a comprehensive understanding of the toolkit. Futures create standardized obligations, options create asymmetric choices backed by insurance premiums, and swaps allow institutions to trade cash flows.
Right.
But tools are only as important as the people using them. We need to examine the actual motivations driving billions of transactions a day. Why do individuals and massive institutions log into these exchanges? The NISM material categorizes the entire market into 3 primary motives: hedging, speculation, and arbitrage.
And every single trade executed in the derivatives market, regardless of how complex the algorithm behind it is, ultimately falls into one of those 3 motivational buckets.
Let's analyze hedging first, because it's generally viewed as the most justifiable, perhaps even the most virtuous of the 3 motives. It's the defensive play.
Hedging is entirely about protection and risk mitigation. A hedger is an individual or a corporation that already owns an underlying asset or already has an existing business exposure, and they want to protect themselves against adverse price movements.
Going back to our commercial airline, When they buy crude oil futures to lock in the price of their jet fuel, they are hedging. They have absolutely no intention of becoming oil traders.
Exactly.
They don't care if the price of oil goes up or down after they lock in their contract. They're not trying to generate speculative profit from the derivative itself. They're simply buying financial armor to protect the profit margins of their core business of flying airplanes.
For a hedger, the derivative is essentially a business expense, a form of insurance paid to guarantee operational stability.
Hmm.
But the hedger cannot exist in a vacuum. If an airline wants to buy a massive amount of oil futures to protect themselves, the mechanics of the market dictate that someone else must be willing to sell them those futures.
Right.
Someone must be willing to take the other side of the trade.
And that leads us directly to the second motive.
Yeah.
Speculation. Now, speculation is a term that carries a massive amount of cultural baggage. If you watch mainstream financial news or read populist economic critiques, the speculator is frequently vilified.
Oh, constantly.
They're portrayed as casino gamblers, Wall Street cowboys who play with imaginary numbers, detached from the real economy, and who occasionally destabilize global markets for their own greedy enrichment.
That's the stereotype.
I have to formulate a defense here. If the airline, the hedger, needs to offload their risk, and other airlines are also trying to offload their risk, a market consisting purely of hedgers would completely freeze. Is the speculator actually the vital counterweight? Does the speculator provide the necessary liquidity that allows the retail listener's mutual fund to operate efficiently?
Your defense is mathematically and structurally correct. To call speculators mere gamblers demonstrates a fundamental misunderstanding of market ecology. A speculator is an entity taking a directional position based on their view of future price movements without having any prior exposure to the underlying asset.
Okay.
They don't own the oil and they don't need the oil. They're simply buying the futures contract at 100 rupees because their models predict the price will hit 110 rupees, allowing them to pocket the spread.
They are driven purely by the profit motive.
Yes, but the byproduct of their profit-seeking is market liquidity. Imagine a derivatives exchange where speculators are completely banned.
Okay, let's play that out.
The airline wants to buy oil futures to lock in fuel prices. But every other airline, shipping company, and logistics firm also want to buy oil futures to protect themselves. There are thousands of buyers seeking protection, but absolutely no sellers willing to take on the risk. The market freezes completely. The hedgers cannot find a counterparty.
Because all the natural participants in the physical market are looking for the exact same directional protection.
Exactly. Speculators are the entities who step into that frozen market and say, I will take the other side of your trade. I will absorb the risk you were terrified of in exchange for the opportunity to make a profit if my analysis is correct. The speculator willingly shoulders the burden of risk. By constantly buying and selling, they provide deep, continuous liquidity. They ensure that whenever a hedger needs to enter or exit a position to protect their business, there is immediately a counterparty available at a fair, continuous price. Without speculators, the hedging mechanism would collapse, and the real-world economy would be subjected to massive, unmitigated volatility shocks.
That's a profound symbiotic relationship. The hedger offloads the catastrophic risk they can't afford to take, and the speculator voluntarily absorbs that risk for a chance at a reward. The system requires both to function. But then we have the third motive, which operates on an entirely different intellectual plane. Arbitrage.
Arbitrage is the most mathematically rigorous and in many ways the most fascinating of the three motives. It is the act of simultaneously exploiting price differentials across different markets to generate a riskless profit.
Okay, wait. The phrase riskless profit sets off massive alarm bells for anyone who has studied finance. The fundamental rule of investing is that risk and reward are correlated. Riskless profit sounds like an impossibility or, at best, a temporary glitch in the matrix.
It is a glitch, and true arbitrage opportunities are incredibly rare and usually vanish in a fraction of a second. But conceptually, let's look at how a basic cash and carry arbitrage model works.
Please do.
Imagine a specific blue-chip stock, let's call it Company X. On the primary cash market, the regular stock exchange where you buy physical shares Company X is currently trading at exactly 100 rupees. However, on the futures exchange, the futures contract for Company X, which expires tomorrow, is mysteriously trading at 102 rupees.
So there's a disconnect. The paper contract is trading for more than the physical asset it's supposed to represent.
Exactly. An arbitrager, which today is usually a high-frequency trading algorithm, detects this 2 rupee pricing anomaly. The algorithm instantly executes two simultaneous trades. It buys the physical stock in the cash market for 100 rupees. At the exact same millisecond, it sells the futures contract at 102 rupees.
Okay, let's trace the math on expiration day, which is tomorrow. Because the arbitrager sold the futures contract, they are legally obligated to deliver the stock. But they already own the physical stock. They bought it yesterday for 100. They deliver the stock to settle the futures contract, and they collect the 102 rupees they locked in.
They bought at 100, sold at 102. They have locked in a 2 rupee profit. It does not matter if the overall stock market crashes by 50% tomorrow or if it surges by 50%. Their profit is completely insulated from market direction because they hold perfectly offsetting positions. That is the definition of riskless profit.
Looking at it from the outside, it seems like the arbitrager is just a financial scavenger, exploiting minute inefficiencies in the system to extract free money without adding any value. But how does this affect the everyday listener? When someone logs into their brokerage app to buy a mutual fund, how does the existence of this arbitrager impact their portfolio?
The arbitrager is the reason the mutual fund investor gets a fair price. While it looks like they are just extracting free money, their actions provide a vital structural service. They act as the market's immune system.
The immune system.
Let's look at the mechanics of their trades. When the arbitrager buys the underpriced physical stock in the cash market, their purchasing volume creates buying pressure, which inevitably pushes the price of the stock up from 100 towards 101.
And simultaneously, when they sell the overpriced futures contract, their massive selling volume creates downward pressure on the futures market, pushing the price down from 102 towards 101.
Exactly. The very act of exploiting the price gap forces the two prices to violently crash back together. The arbitrager's trades force the cash market and the derivatives market into perfect alignment. Because arbitrage algorithms are constantly scanning the global markets, hunting for these tiny discrepancies, they ensure that the price of an asset is uniform across all platforms.
So they prevent the market from fragmenting. Because of the arbitrager, a retail investor knows that if they buy a stock on the Bombay Stock Exchange, they are paying the true, universally agreed upon global price for that asset, not some artificially inflated local anomaly.
The hedger protects the real economy, the speculator provides the oil of liquidity, and the arbitrager acts as the immune system, constantly attacking inefficiencies to keep the pricing structure honest and coherent.
It's a beautifully balanced, self-correcting ecosystem. Now, to truly ground these abstract concepts, we need to look at the specific markets where these motives play out on a massive scale. We need to look at the physical commodities we consume to survive and the fiat currencies we use to trade. This brings us to the real-world anchors of the derivatives market.
The NISM material specifically highlights commodity derivatives and currency derivatives as vital components of the ecosystem. Commodity derivatives are where the invisible financial math collides directly with the physical limitations of the earth.
The real stuff.
Right. These are contracts based on tangible, consumable goods. We're talking about precious and industrial metals, energy resources, and agricultural products. In India, these contracts are heavily traded on specialized platforms like the Multi-Commodity Exchange, the MCX, and the National Commodity and Derivatives Exchange, the NCDEX.
Let's construct a deeply detailed scenario to illustrate how vital these exchanges are. Imagine you're a large-scale wheat farmer. It's the beginning of the planting season. You're sinking massive amounts of capital into your operation today. You're buying expensive fertilizer, maintaining heavy tractors, paying labor costs, and purchasing the seeds.
It's a huge upfront investment.
Exactly. But the terrifying reality of agriculture is that you won't actually harvest and sell that wheat for another 6 to 8 months.
The farmer is stranded in a massive time gap between incurring the costs of production and realizing the revenue of the sale.
During those 6 to 8 months, the farmer is completely at the mercy of chaotic variables. A sudden, unexpected glut in the global wheat supply, perhaps Russia or Australia has a record-breaking harvest, could cause the global price of wheat to plummet. If the open market price drops below the farmer's cost of production, the entire season is a catastrophic loss. They could face bankruptcy and lose the family farm. It's an existential threat.
The agricultural markets are driven by physical realities that cannot be controlled. Drought, floods, supply chain disruptions, and global geopolitics.
But if that farmer utilizes the derivatives market, they can fundamentally alter their reality. They can log on to the NCDEX today and sell a wheat futures contract, mathematically locking in a selling price for their future crop 6 months from now. If their cost of production is 40 rupees a kilo, and they can sell a futures contract at 50 rupees a kilo, they have guaranteed their profit margin.
They have used the derivative to buy the ultimate operational peace of mind.
They can sleep soundly for the next 6 months. If a massive storm destroys crops in another hemisphere and wheat prices spike to 80 rupees, the farmer misses out on that extra profit because they are locked in at 50. But if a supply glut crashes the price to 20 rupees, the farmer is completely insulated. They still get to sell their contract at 50. The derivatives market absorbs the physical shock of the real world.
That is the perfect illustration of a commodity hedge. And the exact same logic applies to the currency derivatives market, which the source material also explores in depth. Currency derivatives allow participants to hedge or speculate on the exchange rate movements between different fiat currencies, such as the US dollar to the Indian rupee pair.
Okay.
These are primarily traded on massive equity exchanges like the NSE and the BSE.
While commodity prices are driven by weather and physical supply chains, currency prices are driven by complex macroeconomic forces. We're talking about the inflation rate differentials between two nations, the aggressive policy decisions of central banks raising or lowering interest rates, and the broader balance of global trade.
To see this in action, imagine a corporate importer in India who manufactures high-end electronics. Their supply chain is highly complex. They have to purchase specialized microchips and components from the United States, and the American suppliers demand to be paid in US dollars. The Indian manufacturer has carefully budgeted their entire production cycle based on an exchange rate of 83 rupees to $1 US.
They calculate their final retail price and their expected profit based on that specific exchange rate. But what happens if the U.S. Federal Reserve unexpectedly raises interest rates, causing global capital to flood into America, which causes the U.S. dollar to rapidly strengthen against the rupee? Suddenly, the exchange rate jumps to 88 rupees to the dollar.
The financial impact is immediate and devastating.
Oh.
The Indian manufacturer now has to spend significantly more rupees just to acquire the exact same amount of US dollars to pay their suppliers.
Right.
The physical cost of the microchips hasn't changed, but the currency devaluation makes them vastly more expensive to import. The manufacturer's profit margin is completely annihilated. They might even have to halt production, not because they built a bad product, but simply because the macroeconomic winds shifted against them.
How does the currency derivatives market prevent this industrial collapse?
The smart CFO of that manufacturing company anticipates the risk. Months in advance, they go to the NSE and buy a USD INR currency futures contract that locks in the exchange rate at 83 rupees for the exact date they need to pay their suppliers.
So they build a financial wall around their supply chain.
Exactly. If the US dollar spikes to 88, the underlying cost of their imported microchips increases. But simultaneously, the value of the currency futures contract they bought also increases because they hold the right to buy dollars at the cheaper price of 83. The profit they make on the derivative contract perfectly offsets the increased cost in the physical supply chain. The derivative acts as a critical macroeconomic shock absorber, allowing international trade to function smoothly despite wild currency fluctuations.
These abstract mathematical contracts are literally the invisible scaffolding holding up the physical logistics networks of the entire world.
It's pretty amazing when you map it out like that.
It is. But this brings us to a massive mechanical question. We discussed earlier how the clearinghouse steps in to guarantee these trades. But how does the exchange mathematically ensure that the wheat farmer or the corporate importer actually gets paid months down the line? How does the system remain solvent? This requires looking under the hood at the strict, ruthless mechanics that govern the market. Let's delve into the engine room.
The engine room of the derivatives market is built on rigid mathematical rules. And the most foundational concept the NISM text introduces here is that the derivative market is inherently a zero-sum game.
A zero-sum game. The phrase itself sounds ominous. Let's break down exactly what that means.
In a zero-sum game, the total wealth of the participants remains entirely constant. No new money is created, and no money is destroyed within the closed loop of the contract. It states mathematically that for every single winner in a derivative transaction, there must be an equal and perfectly opposite loser. If you buy a futures contract and you successfully close it out for a profit of 10,000 rupees, that money did not magically materialize from the ether. The clearinghouse algorithm mathematically extracted exactly 10,000 rupees from the account of the person who took the opposite side of your trade and transferred it directly to you. Your gain is exactly mirrored by their loss.
I have to push back strongly on this concept because To a retail listener, it sounds inherently problematic, if not outright predatory.
Let's hear it.
When I buy a share of a good company and that company invents a new product and grows, the value of the stock goes up. I make money, the founders make money, the employees make money. Wealth is actually created. It's a positive sum environment. But if the derivatives market is purely a zero-sum game, doesn't that make it nothing more than financial combat? Every single time I win, I'm actively taking money directly out of another human being's pocket. It sounds less like investing and more like a highly regulated casino where the only way to succeed is to bankrupt your opponent.
Your reaction is the standard ethical critique of the derivatives market, but it misses a profound and necessary nuance. You have to separate the cash flow from the economic value. Yes, strictly mathematically speaking, the transfer of cash between the two margin accounts is perfectly zero-sum. However, the utility, the actual economic benefit derived from the transaction by the participants, is absolutely not zero-sum.
Okay, wait. How can the economic utility be positive if the cash flow is perfectly zero-sum?
Let's revisit our wheat farmer to demonstrate the difference. The farmer sold a wheat futures contract to a speculator to lock in a guaranteed selling price of 50 rupees a kilo. 6 months pass. A massive global shortage occurs, and the open market price of physical wheat explodes to 80 rupees a kilo.
Okay, let's trace the math. The farmer's futures contract forces him to sell at 50, even though the market is at 80. The farmer effectively lost 30 rupees per kilo on the paper derivative. The speculator who bought the contract made that exact 30 rupees per kilo. The cash flow is zero-sum. The speculator won the financial combat, and the farmer lost.
Mathematically, yes. The farmer's margin account was debited, and the speculator's account was credited. But let's look at the utility. Does the farmer feel like a victim? Does the farmer feel predatory action occurred? Not at all.
Really?
The farmer just harvested and sold their actual physical crop at a price that guaranteed them a healthy, predetermined profit margin. Their primary goal was not to win a paper trade. Their primary goal was absolute price certainty, which allowed them to secure bank financing, pay their workers, and keep their farm solvent.
So the farmer achieved their operational goal.
Exactly. The farmer doesn't mind that the speculator made a massive profit on the paper trade, because the speculator provided the exact insurance policy the farmer desperately needed. Both parties achieved their highly specific divergent goals. The farmer achieved risk mitigation and operational survival. The speculator achieved capital appreciation. The economic utility generated by that transaction was immensely positive for both individuals and for the broader agricultural economy. It's a win-win scenario built on top of zero-sum math.
That is a fundamental paradigm shift in how to view these markets. The cash is zero-sum, but the economic benefit is positive-sum. The intention dictates the value. So when these contracts finally reach their expiration date, how does the actual exchange of value, the settlement, mechanically occur?
The NISM text outlines two entirely different mechanical pathways for settlement: cash settlement and physical settlement. In a cash-settled contract, nobody actually delivers the underlying asset. The counterparties do not exchange barrels of oil or truckloads of wheat.
Okay.
Upon the moment of expiration, the clearinghouse simply calculates the final price differential, debits the loser's account, credits the winner's account with cash, and the contract ceases to exist. It's a purely financial reconciliation.
But the alternative is physical delivery, where the underlying asset must actually change hands.
Physical settlement means the seller must physically deliver the asset to the buyer at an approved warehouse or depository. And it's crucial to note the regulatory stance here. The Securities and Exchange Board of India, SEBI, has intentionally mandated physical settlement for all individual stock derivatives unless a trader specifically squares off or closes their position before the expiration day.
Why would SEBI force physical delivery for stocks? Why not just let everyone settle in cash and avoid the hassle of transferring shares?
SEBI implemented this rule to fundamentally connect the paper derivatives market back to the underlying physical equity market. If everything is cash settled, speculators can take massive, highly leveraged positions without ever having any intention of holding the actual stock. It can lead to wild, disconnected volatility. By forcing physical settlement, SEBI forces large traders to actually procure and deliver the physical shares. It grounds the derivative in the reality of the underlying asset and curbs excessive, unbacked speculation.
However, there's a major exception to this physical delivery rule, right? Index derivatives.
Precisely. Index derivatives, like futures based on the Nifty 50 or the Bank Nifty, remain strictly cash-settled. The logistics dictate this. You obviously cannot physically deliver an entire mathematical index, A trader cannot show up with a cardboard box containing precisely weighted fractional shares of 50 different companies. It's practically impossible, so indices settle in cash.
This brings us back to the most critical vulnerability in the entire system. We talk about how the clearinghouse guarantees the trades to eliminate counterparty risk. If the loser has to pay up on expiration day, whether it's a cash differential or delivering physical shares, what mechanically stops them from simply defaulting?
The margins.
Right, like if a retail trader's account is suddenly down 500,000 rupees on a bad options trade, what stops them from just deleting their brokerage app, ignoring the phone calls, and running away from the obligation?
This is where the concept of margins becomes the absolute lifeblood of the clearinghouse's safety net. When you enter into a derivative contract, you do not pay the full notional value of the underlying asset. But the clearinghouse does not let you trade on pure trust. They demand that you deposit a specific percentage of the contract's total value up front, before the trade is even allowed to execute. This deposit is your margin.
It's skin in the game. It's a safety deposit held in escrow.
Exactly. It is collateral. But the clearinghouse doesn't just arbitrarily guess at what the margin amount should be. They calculate it with ruthless mathematical precision using advanced statistical models. The primary model utilized by clearinghouses globally is called value at risk, commonly referred to as VAR.
VAR is one of the most important concepts in modern finance. Let's unpack how it actually calculates danger.
Value at risk attempts to quantify the absolute maximum potential loss a specific derivative contract could suffer over a defined time frame, usually a single trading day, with a specific degree of statistical confidence, typically set at 99%.
So the clearinghouse algorithm looks at the historical data. It looks at how wildly the price of crude oil, or the Nifty index, has swung up and down over the past 5 years. It calculates the standard deviation of those price movements, and it says, based on historical volatility, we are 99% confident that the price of this contract will not drop by more than 10,000 rupees in a single day.
Precisely. The clearinghouse takes that worst-case scenario calculation and demands that you leave that exact amount of money, 10,000 rupees, locked in your account as margin. They hold enough of your money to cover a 99th percentile disaster.
But the danger of VAR is that it relies entirely on historical data. It assumes the future will look roughly like the past. What happens during a black swan event? What happens when an unprecedented global pandemic hits, or a sovereign nation defaults on its debt and the market crashes in a way that has never been recorded in history? The 99% confidence interval breaks down entirely.
That is the inherent flaw in statistical risk modeling. And it's exactly why the clearinghouse employs a second continuous layer of defense: the mark-to-market process. Margin isn't a one-time deposit. It is dynamically adjusted every single day.
Let's walk through a multi-day scenario to show how ruthless this process is.
Imagine you buy a futures contract, and you deposit the required 10,000 rupees in initial margin based on the VAR model. At the end of trading on day one, the market moves against you, and your contract loses 2,000 rupees in value.
Ouch.
The clearinghouse does not wait until the expiration date to collect that debt. That very evening, during the mark-to-market process, they aggressively reach into your account, deduct the 2,000 rupees, and instantly transfer it to the winner's account. Your margin balance is now depleted to 8,000 rupees.
The pain is immediate and recognized daily.
On day two, the market crashes further. Your position loses another 4,000 rupees. The clearinghouse extracts that money. Your margin balance is now dangerously low, sitting at 4,000 rupees. You have breached what is known as the maintenance margin level.
The safety net is tearing.
At this exact moment, the system automatically triggers a margin call. Your broker alerts you that you must immediately deposit fresh capital into your account to bring the margin back up to the original 10,000 rupee requirement.
And if the trader ignores the margin call, if they can't find the cash?
The system is completely unsentimental. If you don't deposit the funds within the specified time frame, the broker's algorithm will automatically forcibly liquidate your position. They will sell your contract at a loss on the open market to stop the bleeding and protect the clearinghouse. This strict, mechanical, daily reconciliation ensures that massive, hidden losses cannot accumulate over time. It guarantees that the loser always pays the winner, protecting the structural integrity of the entire zero-sum ecosystem.
The system is structurally sound, mathematically rigorous, and incredibly powerful. But as we've extensively discussed, the ability to control vast amounts of underlying assets with only a small margin deposit creates massive leverage. Leverage amplifies gains, but it equally amplifies losses. It's a double-edged sword that can destroy wealth just as easily as it creates it.
Absolutely.
Which brings us to a highly practical question for you, the listener, who might be considering professional wealth management. Knowing how volatile and potentially destructive these tools can be in the wrong hands, how are professional portfolio managers legally permitted to utilize them with an investor's hard-earned capital?
This leads us directly to the highly regulated framework governed by SEBI, specifically regarding how portfolio management services, or PMS, interact with the derivatives market. SEBI recognizes a dual reality. Derivatives are essential, sophisticated tools for managing risk, but they are also weapons of mass financial destruction if used for unchecked speculation by retail investors. Therefore, SEBI allows portfolio managers to access this market, but strictly confines them within a heavily regulated sandbox.
The NISM text makes the primary limitation explicitly clear. It states that portfolio managers are permitted to use derivatives solely for the purposes of hedging and portfolio rebalancing.
That phrase is the bedrock of the regulation. A portfolio manager has a fiduciary duty. They cannot take your retirement savings and make wild, unhedged, highly leveraged directional bets in the options market in a desperate attempt to double your portfolio's return. They are legally barred from acting like aggressive speculators. They are only authorized to use these instruments defensively.
Let's look at portfolio rebalancing as an example. If a manager has a 500 million rupee portfolio and they want to quickly reduce their exposure to the banking sector and increase their exposure to the IT sector, physically selling hundreds of thousands of banking shares and buying hundreds of thousands of IT shares incurs massive transaction costs, taxes, and market impact costs.
It's highly inefficient. Instead, the manager can use index futures to quickly and synthetically alter the portfolio's exposure. They can short Bank Nifty futures and buy IT index futures, achieving the desired rebalancing in seconds with minimal friction. They are using the derivative for operational efficiency, not pure speculation.
And there's a strict mathematical cap on the total risk the manager can expose the client to.
Absolutely. The regulation unequivocally states that the total exposure of a client in derivatives cannot exceed the total value of the client's underlying portfolio. This rule completely eliminates the danger of excessive unchecked leverage.
So if I give a portfolio manager a portfolio worth 50 lakh rupees, they cannot use the margin system to leverage my account and take a 5 crore rupee position in the futures market.
Exactly. They cannot use derivative leverage to punch above the portfolio's actual weight. The risk is legally capped. The worst-case scenario is contained to the total value of the assets you actually possess.
Let me use an analogy to summarize the complex relationship between the individual investor, the portfolio manager, and the turbulent derivatives market. Think of a portfolio manager as an expert, highly trained ship captain that you've hired. You, the investor, are the owner of the ship. The derivatives market is a fast, powerful, incredibly deep, but tremendously dangerous ocean current.
Okay, I like this.
If navigated correctly, that current can get your ship to its destination faster and safer, protecting you from storms. But if navigated recklessly, the current will smash your ship against the rocks and sink it. The captain, despite their expertise, is not legally allowed to simply steer your ship into that dangerous current on a whim.
The captain requires explicit legally binding orders before they alter the course.
Precisely. They need written authorization from the owner. The source material emphasizes that any and all usage of derivatives must be explicitly laid out and mutually agreed upon in the portfolio management agreement. This foundational document must detail the exact quantum of exposure allowed, the specific types of instruments the manager is authorized to use, perhaps only index futures but no options, and the exact predefined purpose for utilizing them. The captain can only navigate the dangerous waters of the derivatives market if you've signed off on the exact coordinates of the route.
That analogy perfectly captures the regulatory philosophy SEBI has engineered. They want to ensure that Indian investors benefit from the sophisticated risk mitigation that derivatives offer, while simultaneously building an impenetrable wall against speculative blowups in retail portfolios. This is why the disclosure document is so vital. It strips away the opacity. It forces the manager to lay everything out transparently. If the portfolio manager violates the strict terms of that written agreement, if they sail into the current without your permission, or if they exceed the leverage limits, they are legally and financially responsible for the breach of fiduciary duty.
The ultimate takeaway for you is one of empowerment. As an investor in a PMS, you are never flying blind. Even if the manager wants to expand their strategies and participate in exchange-traded commodity derivatives, they cannot simply assume your consent. They require your explicit prior written authorization. The institutional structure exists, but the individual investor remains the ultimate boss, holding the keys to their own risk parameters.
It is a framework designed to balance institutional capability with individual sovereignty.
We have journeyed through an incredibly dense, highly technical landscape today, dissecting the invisible architecture of the financial world.
To synthesize our exploration, we began by defining the derivative as a dependent contract, a tool ingeniously designed to separate the financial volatility of an asset from the physical burden of owning it.
We traced the historical evolution from the fragile, bespoke forward contracts that were constantly plagued by liquidity issues and the devastating reality of counterparty default. We saw how the market solved this by creating standardized futures contracts, introducing the clearinghouse and the legal magic of novation to replace vulnerable interpersonal trust with rock-solid institutional guarantees.
We examined the asymmetrical power dynamics of options, analyzing how the buyer purchases the right to choose while the option writer operates a sophisticated insurance model, absorbing massive potential risk in exchange for mathematically calculated premiums. We also explored swaps, witnessing how massive corporations trade the financial weather of interest rates and currencies to stabilize their balance sheets.
We defended the ecosystem by unpacking the motives, how the hedger utilizes derivatives as operational armor, how the speculator voluntarily absorbs risk to provide vital market liquidity, and how the arbitrager acts as the immune system, exploiting inefficiencies to ensure fair pricing for everyone, including the retail mutual fund investor.
We peered into the engine room, differentiating between the zero-sum reality of the cash flows and the profoundly positive-sum reality of the economic utility created. We dissected the ruthless daily mechanics of margins, value-at-risk calculations, and mark-to-market accounting, which prevent systemic defaults.
And finally, we explored the SEBI regulatory sandbox, ensuring that when professional portfolio managers use these powerful tools, they act strictly as fiduciaries, utilizing derivatives only for hedging and rebalancing, with the absolute transparent consent of the investor. It is a profound, incredibly intricate, interlocking system of calculated risk and structured reward.
It is the ultimate manifestation of human ingenuity applied to the problem of uncertainty.
It truly is. Now, as we wrap up this massive deep dive, I want to leave you, the listener, with a final provocative thought to ponder. Throughout our discussion, we emphasized how the centralized clearinghouse completely revolutionized the futures market. By acting as the ultimate, trusted, highly capitalized middleman, the clearinghouse eliminated counterparty risk and transformed global finance from a fragile web of handshakes into a robust, institutionalized behemoth.
The centralized institution is the undisputed bedrock of modern market safety.
But look at the bleeding edge of where technology is heading right now. We are rapidly entering an era defined by blockchain technology and the rise of decentralized finance, commonly known as DeFi. In the DeFi ecosystem, you have the invention of smart contracts. These are essentially pieces of immutable computer code that exist on a distributed ledger. They execute automatically and instantly when specific mathematical conditions are met, completely without the need for any human intervention, oversight, or centralized authority.
In the realm of smart contracts, the code itself is the absolute law.
Exactly. The code cannot be bribed, it cannot panic during a crash, and it doesn't require a massive skyscraper full of compliance officers to enforce the rules. So here's the question for you to mull over as you navigate your own financial journey. In the near future, could smart contracts on a decentralized blockchain automatically execute, settle, and mathematically enforce margin requirements for derivative trades, making the traditional multi-billion-dollar centralized clearinghouse completely obsolete? What happens to the safety and stability of the global derivatives market when autonomous open-source code, rather than a highly regulated institution with a physical address and human regulators, holds the collateral and enforces the zero-sum game? Will the transition from institutional trust to algorithmic trust be the ultimate flawless evolution of the market, or are we simply programming a new, unpredictable kind of systemic risk that no human can stop once it begins?
That is the most vital question facing the next generation of market infrastructure. It is the frontier where pure mathematics attempts to completely replace human institutions.
It's definitely something to think about the next time you hear the word derivative thrown around in the news. Thank you so much for joining us on this extensive deep dive into the underlying forces that shape our economy. Keep learning, keep asking the hard structural questions, and keep examining the invisible architecture of the financial world around you. We'll catch you next time.